Hi, I'd like to talk to you about the return potential of the market over the next 6 and maybe 18 months or less. And we think it's tilted, the return potential tilted to the downside. So we need to be cautious here. We think the most attractive asset class is actually T-bills, yielding 5%. So you might see that in some of your portfolios that I manage for you. And also inverse ETFs. I think that's a great way for investors to protect their portfolios, defer long-term capital gains, and or if you're aggressive, to use them to speculate on the downside of the market. We're not quite there yet in terms of the technicals rolling over to confirm that trend, but keep that in mind. So walking you through kind of how the market's set up a little bit. So remember, there's 6 or 7 stocks that are driving the whole move of the stock market. Well, it was really important last week, the NVIDIA news, the earnings report. They came out and they were actually down 13% in terms of revenue year over year, but guided next quarter up in a major way. I was surprised to see that in their press release, and then they talked about it on a conference call. The stock trades for a very high multiple. We say, okay, give them the benefit of the doubt, give them 50 times earnings. That's really high. And also give them the earnings estimates for next year, 2025, not next year, but 2025, of $10. That gives them a price target of 500. The stock is currently roughly 400. That's 25% over a couple year period. That's not all that compelling. They're going to have to beat in a big way going forward over and over again. But that was a major increase in revenues. There's obviously something going on there. It's their customers wanting to roll out faster and beat the other guy, but also Taiwan Semiconductor, their outsourced semiconductor manufacturer, freed up capacity so they could hit those numbers. Now the stock, you can see the big spike in the stock here, but it's up 100% over the 200-day moving average, and then it's up 33% right here over the 20-day moving average. On our models, that's a technical sell indicator, so just keep that in mind. The 6 stocks that are driving the market, they can't keep doing it. They're going to run out of steam, and the rest of the market has been rolling over. At best case, the stocks are flat. Most of them are down. The cyclical stocks are down for the year. Now, what's going on in the global economy? I think it's rather concerning. When you look at the U.S., they're cutting back or limiting government spending, which is great in the long term, but negative for GDP growth. The Federal Reserve is being very aggressive, and we'll talk about that in a second. But unfortunately, they have to ring in inflation, and they're gonna break the economy by doing this. But anyhow, the U.S. is very slow, and it's probably going to roll over to the recession. We're not getting help out of Europe. Germany has had 2 back-to-back quarters of negative GDP growth. As you know, Germany is the largest economy in Europe. And then China, that dog's not hunting anymore. So they opened up after COVID, and their economy is not performing. I think there's a systemic issue in that economy, that the government is going after the West. The people in China generally like the West, and there's a little bit of a backlash, I think, in terms of spending, consumer spending, and expanding. Obviously, the manufacturing part of their economy is probably contracting in a big way. And I thought it was interesting, the youth unemployment in China, now over 20%. And as you know, a lot of economies, when they hit that level, it really becomes a big issue, as the younger people are not employed and are causing mischief. Now, maybe that's not the case in China, but that's a lot of kids that would probably prefer to be working, making money for their families, and they're not. So the 11% earnings growth for next year that the market's expecting, we don't think it's going to happen. We think it's going to be flat to up a little bit and could be down. The federal funds futures market is discounting another 25% rate increase. I thought we were done with this. If they do another 25 on June 14th, we view it as really negative. So they'll go from 5 up to 5.25 to 5.50 on the Fed funds rate. That's too much, but the current futures market is discounting. They will increase rates. The issue behind this is that the core inflation isn't coming down as fast as expected, and actually was up higher than expected last month, or last month reported last week. So not a very good thing if the Fed increases rates. Again, we think that could be the straw that broke the camel's back. Looking at the GDP for the United States, you can see that the consensus by the Blue Chip Survey of leading economists has the GDP up a little bit for this quarter, for the second quarter. The Atlanta Fed has the GDP now breaking down below 2%. Obviously, we think that the Atlanta Fed's probably too high here, and that the estimates could go flat to even negative for this quarter. So it felt like last week, as we discussed, that the consumer's gone into hibernation. Really bad retail reports, so there's something going on in the economy currently. We are in the stock market, late cycle. So very late cycle, we're in a sideways moving pattern before the economy actually goes into a recession and therefore another bear market. And the stock market's been held up by roughly 6 different technology stocks. And probably was a good thing NVIDIA had a good quarter because it's held up the stock market. But the underlying trend of most stocks is flat to down, especially the cyclical stocks. They all look like they've been through a recession. They're discounting a recession now. The bond market at 3.7%, it's ticked up, but it is also discounting really negative views on the economy versus the short end of the yield curve. So let me walk you through this. So this is important to understand. If you look at the stock market over the last 30 years, it's averaged a 9.8% return over that 30-year period. So that's really good. Standard deviation of 15. I don't like standard deviations that high. When volatility is in that range, it makes me nervous. I don't like it, but if I can get roughly a 10% return, I'll deal with it. So if you look at the underlying fundamentals for the stock market, the next 6 months or maybe 12 months, the return of the stock market is not going to be 9.8%. It's something less than that. So something over here in this, maybe positive, maybe not range, but it's over here to the left. And then what you have to do is you have to take out the upside markets. So we think 1 standard deviation is probably appropriate, but 2 standard deviations above the mean return of 9.8, that's not going to happen. So this potential here in terms of returns are going to be moved over here to the negative side. So you've got about a 34% shot of having a reasonable return in the stock market, and you got about a 66% shot of having mediocre to negative returns for the stock market. So if you move these percentages around a little bit with a 15% standard deviation, your 2 standard deviations might easily be maybe a higher probability as well, but easily be somewhere around 30% on the downside. So when we think about allocating assets, we look at the risk versus return. The return potential in the stock market is not very good right now. T-bills at 5%, 5% on a short-term treasury, that's really competitive. That's a 0 basically standard deviation. That's a really competitive return where the stock market may have a mean return of 5%, but again, with that very high standard deviation and the return potential over to the negative side. Thank you for watching the video, and if you don't hit like, I'm going to come see you. I'm just kidding. But hit like and hit subscribe. Go to my website, Patrick Adams CFA, and get our weekly Marketing Minute update via email. Take care.